Something extraordinary is happening in the gold market right now. And I'm not talking about the price hitting new all-time highs. I'm talking about a fundamental shift in how the world's most powerful institutions view money itself. A shift that's been building quietly for years but is now accelerating at a pace that should concern every person holding dollars, euros, or any fiat currency. Let me show you what I mean. Central banks around the world just completed their largest gold buying spree in modern history. We're not talking about a few tons here and there. We're talking about systematic, aggressive accumulation that tells you everything you need to know about where this is headed. And here's what makes this different from every other gold rally you've seen. The buyers aren't retail investors chasing momentum. They're the institutions that control the global monetary system. Think about that for a second. The very organizations responsible for managing fiat currencies are dumping those currencies to buy gold. It's like watching the captain of the Titanic quietly slip into a lifeboat while telling passengers everything is fine. Except in this case, the passengers are starting to notice. The numbers are staggering. BRICS nations alone now control roughly 20% of the world's official gold reserves. Russia's central bank holds over 2,000 tons. China's been adding to its reserves month after month, and those are just the purchases they're willing to admit publicly. Industry insiders believe the actual number is far higher, with purchases happening through channels that never show up in official reports. But here's where it gets really interesting. These aren't just random purchases. There's a coordinated strategy unfolding. BRICS countries recently acquired 20 tons of gold in what appeared to be a synchronized move. That's roughly $2.5 billion worth of physical metal, bought at a time when prices were already at record highs. When central banks are willing to pay premium prices for an asset, they're not speculating. They're preparing. For what? That's the question that should keep you up at night. Let's talk about what's really driving this. The US dollar has been the world's reserve currency since the end of World War II. That status gave America an extraordinary privilege, the ability to print money and export inflation to the rest of the world. But that privilege came with responsibilities, and over the past few decades, those responsibilities have been increasingly ignored. The dollar index recently dropped over 9% in a single year. That might not sound dramatic until you realize we're talking about the world's reserve currency. A 9% decline in the dollar means every country holding dollar reserves just watched their wealth evaporate. Every central bank sitting on US Treasury bonds just took a massive loss, and they're not happy about it. This is where gold comes in. Gold doesn't have a central bank that can print more of it. Gold doesn't have a government that can devalue it through monetary policy. Gold is the ultimate neutral reserve asset, and right now, the world is remembering why that matters. The price action tells the story. Gold recently surged past $3,900 per ounce, setting a new record high. But here's what most people miss. This isn't a speculative bubble. This is repricing. The market is finally recognizing that gold has been undervalued relative to the explosion in global money supply over the past 15 years. Think back to 2008. The financial crisis hit, and central banks responded by printing trillions of dollars, euros, yen, and yuan. They called it quantitative easing, but it was really just money printing on a scale never seen in human history. Gold responded by rallying from around $700 to over $1,900 by 2011. Then it corrected and spent years consolidating. But here's the thing. The money printing never stopped. It accelerated. The pandemic hit, and central banks printed more money in 2 years than they had in the previous decade. The M2 money supply in the United States alone increased by over 40%. That's not a typo. 40% more dollars created in just 2 years. Gold didn't immediately respond because the narrative was all about inflation being transitory, about the economy recovering, about everything going back to normal. But smart money knew better. Central banks knew better. And they started buying. Now we're seeing the result. Gold isn't just going up because of inflation. It's going up because the entire global monetary system is being questioned. Countries are looking at their dollar reserves and asking a very simple question. What happens when the U.S. can't or won't honor its obligations? The U.S. national debt just crossed $36 trillion. The interest payments on that debt now exceed the entire defense budget. Think about that. America spends more money just paying interest on its debt than it does on its entire military. And those interest payments are going up as rates remain elevated. How does this get resolved? There are only 3 options. Option 1, The U.S. government dramatically cuts spending and raises taxes to pay down the debt. That's political suicide, and no politician is willing to do it. Option 2. The U.S. defaults on its debt. That would destroy the dollar's reserve currency status overnight and trigger a global financial crisis that would make 2008 look like a minor correction. Option 3. The Federal Reserve prints money to buy government debt, effectively monetizing the deficit and destroying the dollar's purchasing power through inflation. Which option do you think they'll choose? If you're a central bank holding hundreds of billions in dollar reserves, you're not waiting to find out. You're buying gold. And it's not just about the debt, it's about trust. The U.S. has weaponized the dollar in ways that are making other countries extremely nervous. When Russia invaded Ukraine, the West froze Russian central bank reserves, hundreds of billions of dollars, just frozen. Regardless of how you feel about the conflict, that action sent shockwaves through every central bank in the world. If the U.S. can freeze Russia's reserves, whose reserves are safe? China's watching this very carefully. Saudi Arabia's watching, India's watching, and they're all reaching the same conclusion. Dollar reserves aren't as safe as they thought. Gold, stored in your own vaults, can't be frozen by a foreign government. This is why we're seeing this massive shift. It's not about gold going up. It's about the dollar going down. And not just the dollar, but faith in the entire fiat currency system. Let me give you some context on what this means for regular people. If you're holding cash, you're holding a depreciating asset. If you're holding bonds, you're holding a depreciating asset. If you're holding anything denominated in fiat currency, you're watching your purchasing power erode in real time. The official inflation numbers say inflation is around 3%, but anyone who buys groceries, pays rent, or fills up their gas tank knows the real number is much higher. The way they calculate inflation has been changed multiple times over the decades to make the numbers look better. If we use the same methodology from the 1980s, current inflation would be closer to 10%. That means your cash is losing 10% of its purchasing power every year. $100,000 today will be worth $90,000 in real terms next year, $81,000 the year after that. This is the hidden tax of inflation, and it's devastating for anyone trying to save money or preserve wealth. Now, I want to take a quick aside here because this is relevant to a lot of people watching. If you're sitting on $100,000 or more in retirement accounts, there's something you should know about. Gold IRAs allow you to hold physical gold inside your retirement account without triggering tax penalties. I put together a free guide that covers exactly how this works, what the rules are, and how to evaluate if it makes sense for your situation. It's in the description below. No pressure, but if you're concerned about the purchasing power of your retirement savings, it's worth looking into. All right, back to what's happening in the market, because the central bank buying is only part of the story. We're also seeing massive moves in the physical gold market that suggest something bigger is coming. The COMEX, which is the major futures exchange for gold in the United States, has been experiencing unusual stress. The amount of physical gold available for delivery has been declining, while open interest has been increasing. What does that mean in plain English? It means there are more paper claims on gold than there is actual physical gold to back those claims. This is how the gold market has operated for decades. Most gold trading happens on paper. Futures contracts, ETFs, certificates. Very little actual physical metal changes hands. But when confidence in the system breaks down, people start asking for physical delivery. And that's when you find out how much gold really exists. We saw a preview of this during the pandemic. Gold futures in New York were trading at a significant premium to physical gold in London because there were logistical problems getting physical metal delivered. The paper market and the physical market temporarily disconnected. That was a warning shot. Now we're seeing signs of stress again. The spread between paper gold and physical gold has been widening. Premiums on physical coins and bars have been increasing. Delivery times have been extending. These are all symptoms of a market where demand for physical metal is overwhelming the available supply. And here's the kicker. If there's ever a real run on physical gold, if institutions and individuals simultaneously demand delivery of their metal, the paper market will collapse. The price of gold will gap up dramatically as the market reprices to reflect actual physical scarcity rather than paper abundance. This is what happened in the 1970s. Gold was fixed at $35 per ounce under the Bretton Woods system, but the U.S. was printing money to fund the Vietnam War and Great Society programs, and other countries started demanding their gold back. France famously sent a warship to New York to pick up its gold. Eventually, Nixon had no choice but to close the gold window in 1971, ending the dollar's convertibility to gold. What happened next? Gold went from $35 to over $800 by 1980. That's not a 20% gain or a 50% gain. That's a 2,300% gain in less than a decade. And it happened because the market finally recognized that dollars were being printed far in excess of the gold backing them. We're in a similar situation now, except the numbers are far larger. The amount of currency in circulation globally is measured in the hundreds of trillions. The total value of all gold ever mined is around 15 trillion at current prices. If even a small percentage of that currency tries to move into gold, the price will explode. But let's talk about the supply side, because that's equally important. Gold production has been essentially flat for years. The easy gold has been mined. New discoveries are rare and expensive to develop. It takes 7 to 10 years to bring a new gold mine into production, and that's if you can get the permits and financing. Meanwhile, demand is surging. Central banks are buying. Retail investors in Asia are buying. Institutions are buying. And industrial demand continues because gold is used in electronics, medical devices, and other applications where its unique properties make it irreplaceable. When you have flat supply and surging demand, there's only one way for the market to clear: higher prices. Much higher prices. Some analysts are projecting gold could reach $5,000 per ounce within the next few years. Others think that's conservative and are calling for $7,000 or even $10,000. These aren't wild-eyed speculators. These are serious analysts looking at the fundamentals and doing the math. Here's how they get to those numbers. If you look at the total money supply and compare it to the total gold supply, gold is dramatically undervalued relative to historical norms. In 1980, when gold hit its previous inflation-adjusted peak, the gold-to-money ratio was much higher than it is today. To get back to that ratio, gold would need to be somewhere between $8,000 and $12,000 per ounce. Now, I'm not saying gold will definitely hit those levels. Markets don't move in straight lines, and there will be corrections along the way. But the direction is clear, the fundamentals are clear, and the smart money is positioning accordingly. Let's talk about what this means for different types of investors. If you're young and have decades until retirement, you have time to ride out volatility. A position in gold or gold mining stocks could provide significant upside, while also serving as insurance against monetary chaos. If you're closer to retirement or already retired, the calculus is different. You need to preserve what you have. You can't afford to watch your purchasing power evaporate. This is where physical gold becomes crucial. Not paper gold, not gold ETFs, but actual physical metal that you own and control. Because in a real crisis, paper promises might not be worth much. We've seen this throughout history. When the system breaks down, people want tangible assets. Gold coins, gold bars, stored in a secure location that you control. That's real wealth preservation. That's what central banks are doing. That's what wealthy families have done for generations. And that's what more and more regular people are starting to understand they need to do. But here's what most people get wrong about gold. They think of it as an investment that needs to go up in value. That's not the right way to think about it. Gold doesn't go up or down. Gold is the constant. It's currencies that go up or down relative to gold. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. It's not that gold went up. It's that currencies lost purchasing power. Gold maintained its purchasing power while everything else declined. This is why gold is called a store of value. It's not about getting rich. It's about not getting poor. It's about preserving your wealth across time and across monetary regimes. And in an era where governments are printing money at unprecedented rates, that preservation function is more important than ever. Now let's talk about the geopolitical dimension, because that's driving a lot of what we're seeing. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus several other countries that have joined or are seeking to join, represent a massive portion of global GDP and population, and they're increasingly coordinating to reduce their dependence on the dollar. They're settling trade in their own currencies, they're building alternative payment systems to bypass SWIFT, and they're accumulating gold as a neutral reserve asset that doesn't give any one country an advantage. There's been talk of a BRICS currency backed by gold, or a basket of commodities. Whether that actually happens or not, the intent is clear. Reduce dollar dependence. This is a direct threat to U.S. economic hegemony. The dollar's reserve currency status is what allows the U.S. to run massive deficits without immediate consequences. It's what allows the U.S. to sanction other countries and cut them off from the global financial system. If that status erodes, America's economic and geopolitical power erodes with it. The U.S. government understands this, which is why there's been increasing talk about the strategic importance of gold. Some politicians have even suggested that the U.S. should be buying more gold for its reserves. The irony is rich. The same government that has spent decades dismissing gold as a barbarous relic is now worried about other countries accumulating it. But here's the thing. The U.S. officially holds over 8,000 tons of gold, the largest reserves in the world. The question is whether that gold is actually there. The last full audit of Fort Knox was in 1953. There have been partial audits since then, but no comprehensive independent verification of the entire U.S. gold reserve. Some people believe the gold is there and accounted for. Others are skeptical, pointing to the lack of transparency and the fact that the U.S. has been resistant to a full audit. If the gold is there, why not prove it? If it's not there, or if some of it has been leased or swapped, that would be a scandal of historic proportions. Regardless of what's in Fort Knox, the trend is clear. Gold is being remonetized. After decades of being treated as a quaint historical artifact, gold is returning to its role as the ultimate form of money. And this time, it's not governments forcing the issue. It's the market demanding it. We're watching the end of an era, the era of pure fiat currency, where money is backed by nothing but government promises, is coming to a close. It's been tried before throughout history, and it always ends the same way, with currency debasement, inflation, and eventually collapse. The only question is how long it takes and how much wealth is destroyed in the process. The smart money isn't waiting to find out. They're moving into hard assets now, while they still can. Gold, silver, real estate, productive businesses. Things that have intrinsic value and can't be printed into existence by a central bank. And here's what's fascinating. Despite everything I've just told you, despite the record central bank buying, despite the geopolitical shifts, despite the monetary chaos, most people still don't own any gold. The average American has zero exposure to precious metals. They're completely dependent on the dollar and the financial system maintaining stability. That's a massive risk. It's a bet that the government will get its fiscal house in order, that the Federal Reserve will successfully navigate between inflation and recession, that the dollar will maintain its reserve currency status, and that the entire global financial system will continue functioning as it has for the past several decades. Maybe that bet pays off. But what if it doesn't? What if we're in the early stages of a monetary crisis that will reshape the global economy? What if the next few years look more like the 1970s than the past decade? If that happens, the people who position themselves in gold early will be the ones who preserve their wealth. The people who waited will be the ones scrambling to get in at much higher prices, if they can get in at all. This is the turning point. This is the moment when the trajectory of the global monetary system is being determined, and the institutions that control trillions of dollars have already made their decision. They're buying gold. The question is, what are you going to do? Because here's the reality. You can't stop what's coming. You can't change government policy. You can't control the Federal Reserve. You can't prevent other countries from moving away from the dollar. But you can control how you position yourself. You can control whether you're holding depreciating paper or appreciating hard assets. The wealth transfer that's coming will be one of the largest in history. Wealth will flow from those holding fiat currency to those holding real assets, from those who trusted the system to those who prepared for its failure, from those who believed the official narrative to those who looked at the data and made their own decisions. Gold wins. Not because it's going up, but because everything else is going down. Not because it's a great investment, but because it's the ultimate insurance policy. Not because it will make you rich, but because it will prevent you from becoming poor. The central banks know this. The wealthy families know this. The institutions know this. And now you know this. The only question is what you're going to do with that knowledge, because the turning point is here. The shift is happening, and the window to position yourself is closing faster than most people realize. This isn't fear-mongering. This is pattern recognition. This is understanding history and applying those lessons to the present. Every fiat currency in history has eventually failed. Every government that printed money without restraint has eventually faced a reckoning. Every monetary system built on debt and promises has eventually collapsed. We're not different. We're not special. The same laws of economics that applied throughout history still apply today. And those laws are telling us that gold is about to have its moment. Not because gold is changing, but because everything around gold is changing. The global monetary system is being reset. The question isn't whether it will happen. The question is whether you'll be ready when it does.